All right, we'll go ahead and start in five, four, three, two, one.
Hello, everyone. Wade Como with Catalyst Funding. Uh, as always, have Jeff Johnson, my partner in crime, over at Catalyst again. And then we also have a special guest, Michael Sego, today. Always excited to have Michael and his insights on the webinar as well. Michael, welcome.
Thank you, Wade. Thank you, Jeff.
Yeah,
Happy you're here.
so for those of you that do not know, Sego and his team are arguably the best team in the state for helping real estate investors do a wide variety of things. They not only find off-market deals, they're also real estate agents. They have a property management company, a construction company, and really try to provide what I consider to be the most well-rounded and complete service to try and help make things easier for real estate investors. So Sego, we're very excited to have you on the call and also to work with you on a lot of different transactions. So why don't you update us on what's going on with your group?
We just had a deal night with Total Wealth Academy, which valued the relationship with Catalyst and your team. I think we put on a pretty good performance. I think we've got four or five of the transactions that we presented. We presented a total of six. Under contract, we got one more that we're trying to get moved this week, get closed before the end of the month, and looking forward to another one here maybe the second week of October at another place. So it's things are moving, interest rates are dropping. I think it's a great time for investors to kind of get off the bench that have been sitting out for the last maybe 2 years with the interest rates a little bit higher where they are. I don't care where the interest rates are. I still think it's a great time to buy real estate. It's not about the interest rates, it's about your purchase price on it.
Yeah, absolutely. I know you've remained an active buyer and supporter of others. So I know you're putting your money where your mouth is there. And I do agree with you. We're going to cover a lot of slides today that really indicate that it's a great time to buy for a wide variety of data-driven reasons, and that the biggest mistake you can make in this business is trying to time the market perfectly. Um, that's in any market, right? Trying to time the stock market perfectly or the real estate market perfectly or any market. If you're trying to do that, you really limit yourself because you're often going to miss the great opportunities. And we always talk about just being a consistent buyer. If you're a person who can buy two houses a year, just do that every year. If you're a person that can buy 10, do that every year. Just be consistent with it and not try to time things perfectly because it's really impossible to do. Jeff, what else? You have anything before we dive in?
No, I was going to let Michael I know he brings properties, but before we get into the presentation, Michael, if you want to tell people, I know you guys do property management as well, correct?
We do property management. We've I've been an investor since 1996, and I've been doing my own property management for the rentals that I've had personally. We started really kind of venturing out to clients in 2015. We consistently get over market rents, just simply because one, I think we've got a better product than our investors have a better product than what's out there. And we've got tried and true processes in terms of using a lot of social media platforms to get properties at higher rents. And we're consistently doing that. Even, we had some appraisals, and I know appraisers have to use information that's available, and that's going to be the MLS. But, we rarely put our properties on MLS simply because we get competition at that. And I'd rather have our social media platforms and not have competitions, like apartments.com. They pull the information, but they also advertise the top 5 rental properties within a half a mile of subject property. That doesn't do any good for our investors, not at all. I want our investors to have the highest possible rents out there, so they're cash flowing even when interest rates are high. Even though I think it's an equity capture market at the moment, we're still seeing investors that are getting $200, $300, $400 a month positive cash flow after expenses.
Yeah. And the great thing about right now, it is definitely a buy the property or marry the property. And date the rate, sorry, because we're going to be able to refinance most of these properties in the very near future, hopefully the next year or two, at a significantly lower interest rate, increasing your cash flow, but you're able to buy these properties at far lower out of pocket than you will be able to whenever rates truly come down. As a reminder to everybody, if you haven't heard this on our calls before, whenever rates were extremely low, the average out of pocket on loans at Catalyst Funding was $45,000. Those deals did cash flow more, but once you put the 45,000 in, you can never get that back. Conversely, if you buy whenever rates are higher and the out of pockets are significantly lower, because we're averaging about half of that at the moment, maybe even less, you're able to refinance at a lower rate, still get great cash flow, but your out of pocket was significantly lower. And in this game, cash flow is the easiest metric, but the most important metric is return on investment. If your out of pocket is very low, then even lower cash flows are a huge opportunity. All right, a couple other quick things before we dive in. Quick disclaimer. If we could go back to that, just reminding everybody that Seago Group and Catalyst Funding are not giving you direct investment advice. You need to do your own due diligence, and we are merely giving our opinions about the market and not giving direct investment advice. Quick things on Catalyst. For those of you that do not know, we pride ourselves on being a one-stop shop for real estate investment lending. Our focus is single-family 1 to 4, hard money. That's the money to purchase and repair distressed real estate, and then also long-term loans, both in the DSCR or no income doc space, as well as conventional loans. And we can do that all with one loan officer, one credit pool, and can craft a plan for you to succeed by taking advantage of the great products we have from a financing perspective. We also are very good in the space of helping you do fixed to rent. That's our primary place where we differentiate ourselves. We have a very integrated process without a lot of friction, and we can get you in and out of that hard money loan a lot faster than the competition. All right, let's dive right in. So, Seago, I know that you do a lot of your business in Houston. So what are you seeing on the Houston data?
You know, we're seeing inventory, I feel, is coming down a little bit. My wife handles our on-market transactions, so listings on MLS, buyers on MLS, and we have seen over the last 3 weeks an uptick on showings. We've got an offer in on a property that's sat on the market for the better part of 9 months. So, we're seeing it turn a little bit. I know we're getting ready to come up into the holiday season, and most agents and investors like, hey, we're going to take the time off. The way that I kind of feel as we're coming up to the holiday season, I think it's a really good time for a buyer to jump in there, whether they're an investor or going to be an owner-occupied buyer, being able to pick up a property on a good deal as interest rates are falling. So, that's kind of my take as we get into this last quarter here of 2025.
Yeah, I agree. Looking at the data here, the market in Houston and several of the Texas markets is relatively flat, but that represents a buyer's market. If you look at the months of inventory, 5.4, 6 months is the break point between a seller's and a buyer's market. So we're definitely the closest to a buyer's market that you almost ever see in Houston, because it's a very consistent market, not a lot of ups and downs. 52 days on market, that's not an extremely high number, but definitely trending towards a buyer's market. And the thing is, if you're an investor, if you get to this point where we are right now, where sellers have fewer options, like true sellers on the MLS, it's just not a hot market. People like Michael Seago and other wholesalers can get more attractive deals under contract and present them to you. If we get to a point where the market's super hot, it's much more difficult to get attractive opportunities. So now is truly a time because it's a buyer's market. Jeff, I saw you shaking your head. Tell the people a little bit about what you believe about that.
So the things that I look at the total home sales, right? So this year relative to last year, it's up 10%, right? But then I skip down to the listings, and you look at the number of listings, it's double the number of listings for roughly, an extra 10%. So that would lead me to believe that there is still a ton of inventory out there.
Yep.
So I see a lot of opportunities for people to try and pick up some properties. Obviously, Michael, those off-market properties, but even some of these that are on market, like you said, as the months of inventory linger, You may have sellers that get a little more desperate. I am curious, Michael, because I know you work with a ton of folks, wholesalers, and you guys do it as well. Are you seeing any kind of uptick on, I don't want to say off market deals, but basically wholesale deals where they are on MLS, but they are deeply discounted relative to what they're listed at? So you're able to pick up some of those deals that are even on there on the MLS, but you're able to pick them up at a huge discount to make sense for investors.
Yeah, I have, especially over the last probably 6 weeks, I have seen an uptick on the number of transactions that are coming across my text and email and phone calls. And I think it gets down to the time of year. We're coming in what I call the silly season with the holidays and a lot of traveling and family coming in town and traveling to family out of state. We are seeing my phone, we've been on this for 11 minutes right now, and I've had 3 different texts of some of my bird dogs reaching out and saying, "Hey, Michael, I've got a property. Let's run some numbers on it, see if we can get it moved." And that's just the last 11 minutes. I can't even look at my email at the moment with being on this Zoom call. So yeah, we're seeing a lot more inventory, and I think it has to do with the time of the year. I know investors have made money. I know our investors have made money in 2025. I think it's a really good time to pick up a additional property or two before the end of the year, get some rehab in and offset some of those profits that you've accumulated in 2025 with some expenses on a new property.
I did have one last question for you, because you mentioned that you lease your properties, you don't list them, right, for your folks. I was looking at the days on market, 35 days on market. How does that compare to how you're listing your properties?
We're probably running 20 to 25 days on average. Do we have some, and I'm gonna take a quick peek at one spreadsheet I've got. This week alone, we have, and it's Thursday at 12:15. We've got 7 new leases this week alone, and that's starting on Monday morning. So the people are reaching out to us. We're able to lease some properties for our investors on rehabs that have been completed here in the last couple of weeks. One of them is actually not even completed. So we're doing a punch out list over the next couple of days, and the tenant's moving in on Monday. So, we are getting, as I said, above market rents with our advertising that we do. So yeah, things are moving.
Very good.
All right.
Let's check out Dallas. I know, Seago, you often are up in Dallas. We both value that Total Wealth Academy relationship. You're up there working with some of their members quite regularly, and I know you have some relationships up there as well. What are you seeing in the Dallas data?
Dallas it's definitely a different market than Houston. It is, it's a little bit more white collar than what we have in Houston. Their price point is definitely higher than what the Houston market is at the moment, the Dallas Fort Worth, Arlington area. For investors, I think you got to get outside Dallas, go to some of the small towns that circle around Dallas, Fort Worth, and Arlington, in order to find some of the deals that we're able to find in Houston, the Golden Triangle down here. I haven't had a chance. It looks like, their days on market a little bit longer, about 8 days longer. Looks like their volume's up in terms of home sales, and looks like the listings have increased a little over 20% from this time last year. So, and rents are flat, which rents are flat across everywhere. And that's not just Dallas, Fort Worth. I think that's Houston, San Antonio, and Austin as well. I just think the rents are flat. We had big appreciation of rental rates over the last 4 or 5 years, especially during COVID and right after COVID.
Yep. One thing that's interesting to me is like the days on market are higher than Houston, and the months of inventory are comparable, but the inventory is not up nearly as much. Like the active listings are just slightly up from
That's
where they were previously.
I noticed the same thing.
Number.
Yeah.
Now, somehow Houston is still turning through that inventory in the same time frame, but it's definitely a lot less inventory. And Dallas is actually slightly down, whereas Houston is relatively flat. So that's a very interesting number. I'm not sure exactly what to take from that, but I will say that I think that Dallas, if you look at that pre-COVID and the pre-COVID appreciation numbers, they're still by far the best in Texas. That's like over a 6-year period, almost 10%, and no one else is really close to that.
Yeah, I would guess, just looking at those numbers, just looking at the sales relative to the listings, and then looking at Houston, right? The sales are pretty flat, and the listings are up 20%. Don't get me wrong. But like you said, you compare that to Houston, where sales are up 11%, but listings have doubled. It tells me that you're probably going to get better out-of-pocket deals down here, is my guess.
And we're seeing that.
Probably a little pricier up in Dallas. Now, like Michael said, if you want to go venture out away from Dallas proper and get into the smaller towns, then that probably changes the game significantly. And that's what a lot of folks are doing. But if in Dallas, I'm guessing you're still, while it's not the height of the $50,000 out of pocket, they're still probably significantly higher than Dallas or San Antonio. I mean, Houston or San Antonio.
Yep. All right, let's pop over to San Antonio. And Jeff, what are you seeing there in San Antonio? I know we have boots on the ground there and are closing a lot of loans.
Yeah. Chris, our loan officer in San Antonio, doing a great job. So I look at the first two cities, right, Houston and Dallas. Excuse me. The sales price, Houston's flat, down 1%. Dallas is down 3%. San Antonio, while their median price is down, their average is up, right, up 3%. That's the only of the 6 numbers between the 3 cities. That's the only positive number. And I know previously, there was a while there, maybe 6 months ago, maybe a little bit longer, where the numbers in San Antonio were a little more bleak, but they are just making a comeback, right? In my opinion, they seem to be a little quicker to rebound, say, than the other cities. They're gaining. If you look at what pre-COVID, they're at 38% average sales price, while Dallas is 58, Houston's 36. So if you're looking at just over the last 6 years, San Antonio prices have gone up more than Houston prices. Now the inventory is pretty high, right? I think between San Antonio and Austin, they kind of blend together a little bit. They have a little more inventory, so you have to account for that. But I think prices are pretty solid in San Antonio. It's a really good rental market as well.
So, do you and your team do many deals over there in San Antonio?
Yeah, we do a handful a year. We just had a client that had bought a property about 3 years ago. We got it sold here last month. And she bought it at the height. I think she had to overpay by about $30,000. I think she lost a little bit overall from when we sold it last month. Yeah, it is a little bit different market. But I kind of agree with Jeff. I think it's turned around. Some other industry and lending companies are saying the same thing, that it's kind of picking up a little bit in San Antonio, and they're moving a little bit faster over there.
Yeah, and I think we'll cover, like, there are a lot of prognosticators, national prognosticators, and whenever we look at the data on the affordability index, the average home price in San Antonio is significantly less than Houston, but the median income is comparable. So I think there's a lot of upside there. We'll cover that a little bit later on. Let's hop into Austin. In Austin, I know neither of our groups do a tremendous amount of single-family rental properties there. We do lend on some flips over there. I still think that's a pretty solid flip market, always has been. The prices are up slightly year over year. The appreciation is kind of right in line with San Antonio and Austin. I'm sorry, San Antonio and Houston over that period, down from Dallas, obviously. Inventory is definitely up, comparable to Houston, about double where it was pre-COVID. Not drastically up from where it was last year, up 15%. Days on market, one of the longer out of all these comparisons, and I think the months of inventory is at the top. So I think it is a little bit slower market. Austin is not unlike Dallas. You got to go pretty far out to find single family rentals. But I will say, Catalyst is excited to lend on those single family 1 to 4, like duplexes, triplexes, quadplexes. Austin has a lot of those. And I think that those are very attractive investment opportunities in Austin. It's really tough to make a single family cash flow over there. It's not easy.
I noticed the days on market. So all three of the other cities, days on market are up 5 days, 8 days, 9 days. Austin's actually down 2. So I think Austin was a little ahead of everybody else. They had that giant run up, and then they had a pullback. So the days on market reducing when everyone else is going up. It tells me maybe things are turning around in Austin a little bit.
Yep. Okay, let's go to this next slide, Jeff. You work very, very closely with you know, the refinances that we're doing on the single families that we're working on with Seago and other groups whenever we're refinancing them. So we've had much more attractive rates recently. Tell us a little bit about what you're seeing and what this slide says for us.
So I'll run through the slide and then we can just talk about it. But you know, the Fed obviously cut rates. The rate cut impact is not immediate. Typical lag is 6 to 12 months before appreciation, 12 to 18 full months to momentum. You know, I'll just start talking about it. I'm gonna read the whole thing. The thing that was interesting was there was a lot of folks that I heard from talking to my team. The borrowers were saying, "Hey, Powell's going to speak. You know, I want to see if he cuts rates. Then I want to lock my loan." And if you guys noticed, what happened was they cut rates. The Fed cut the rates, but interest rates did not drop. Interest rates actually ticked up slightly, and it's because they've been anticipating over a while this 25 to 50 basis points move. And so while what the Fed does matters, there's also this anticipation, right? And it's really about the 10-year treasury that decides mortgage interest rates. And so investors are they're taking all the data with the jobs report, trying to read the tea leaves and figure out where rates are going to go. So when, you know, the market says, okay, maybe half is going to say a quarter point, and the other half are betting on 50 basis points. And if it's only 25, that's why you get a little bit of rate increase, actually, because the rate market is kind of taking all the data in and pricing that into making their bond buying decisions, as opposed to like, well, as soon as they lower rates drop. That's not how it works. That said, rates, you know, overall, obviously compared to rates recently, they're down, right? So it's easier for folks to cash flow. We're starting to see some people, you know, refinance, right? We've had solid appreciation, so the rates are, you know, good enough to say, hey, I'm going to pull some cash out to go buy more properties. You know, like you said earlier, Wade, you know, marry the deal and not the rate. You know, as rates drop, the properties that you hopefully bought over the last couple of years and maybe have a higher interest rate, you know, you're going to start to reap the benefits, because as soon as rates drop to a point where it makes sense, all of a sudden that deal, you're like, man, I'm only making $100 cash flow. I bought that deal 2-3 years ago. You refinance and all of a sudden it's 300, right? And you've enjoyed that appreciation. So it's, you know, I think they went down, which is very helpful to refinances and investors. But if the only thing I'll say, and you guys can comment, if it looks like they're going to keep going down, that's when the public decides to jump in and become investors, and you start to see cash out of pocket go back up on these deals.
For sure. Yeah, two quick things. I think you said this, but I'm going to try and summarize it. To Jeff's point, the data, what's important about the data whenever Powell announces it, whenever they announce the job reports or whatever, it doesn't matter if the news is good or bad per se. It matters how it corresponds with the expectation. That's all that really matters. So if the expectation was a quarter to a half and you get a quarter, that's not great news. A half would mean that rates are lowered. Quarter means that they go up. So that is the issue. So for people who think Powell comes out and lowers rates, it means a corresponding rate reduction. It's just not true. It also follows the 10-year rate, not the Fed funds rate. So that's another misunderstanding. But some great news is that the spread on mortgage rates is about a 3.5-year low. That means the spread above the 10-year is really low, that's because the bonds are perceived to be less risky at the moment than they were 3.5 years ago. There is some positive movement there. Those things in concert with what the bond market is currently saying, that they're anticipating 2 more quarter point cuts this year and 1 at the beginning of next year to probably get us to about a 3.25 Fed funds rate, which should correspondingly possibly reduce rates by another 3/4, which is really good news. But like Jeff said earlier, if you're waiting on that rate reduction, your out of pocket's going to go up. So now's the time to really sweep in and buy properties before all that happens, right? Anything to add on that?
Yeah, you ever talk rates with your people, Michael?
Say that again?
So do your potential buyers, you guys ever discuss interest rates and whatnot?
No, I don't. And the reason that I don't is, my investment philosophy is I really haven't been interest rate sensitive in my 30 years. Simply because, if I can get into an investment property for little or no money out of pocket, I don't even mind if my cash flow is break even, because I'm going to do a price increase the following year and potentially do a refinance when interest rates fall. So I really don't. If an investor wants to talk about interest rates, then I'll have a conversation with them. I'll share my philosophy. But then I definitely want to refer them back to their loan officer or their lender to have that frank conversation with them, because, really, if you're worried about interest rates, you may not be the real estate investor that you need to be. And I think you're missing deals left and right if you're really worried about a quarter point on an interest rate. Now, if it's 2 points, I understand. And I definitely use hard money loan to purchase my investment properties and then refinance into a DSCR or conventional loan. So yes, I'm willing to have a conversation on interest rates with investors, but every investor is different, and I do share my philosophy on it.
I've heard you say this in the past. I definitely agree with it. Financing terms are just a cost of doing business.
Correct.
Every quality real estate investor who's ever made money uses leverage 100%. There's nobody like the wealthiest real estate investors on earth are not buying everything for cash. They're just not. They all use leverage, and leverage is where you're able to really increase your return on investment. If you go out and buy everything for cash, I don't care if you have 100,000, millions, tens of millions, billions. It's a mistake, because leverage is the key game in real estate investing. There's no doubt about that. All right, next slide. So let's see. Hold on. Sorry about this. All right. Yeah, next slide we have here is talking about the hottest markets. Interestingly enough, Alabama seems to be the hottest market for real estate investment activity, but Texas is also in the green here. And one of the things I always like to look at is there are, people that we would all agree seem to be extremely intelligent because they seem to make excessive amounts of money for really long time frames. Institutional investors, the BlackRocks, the State Streets of the world. They have incredible advantages over the average person, and they're choosing to put an enormous amount of money into single family real estate. And candidly, Texas is one of the markets they are most aggressively in. So that's 2 things that I think are important about that. One, it means that they are very smart people, and if you're doing it, you're probably also making a smart decision. And 2, I think that they're going to continue to help buoy prices over time, right? I mean, it's a countless other reasons. We always talk about Texas being a great market to invest in. People are moving here, very reasonable prices, low cost of living, low tax rates, et cetera. But when the smartest people in the business, they can put their money anywhere, are choosing to put into Texas single family real estate, I think that's a real good indicator about the future. What do you guys think about this slide? Anything else I heard?
Well, as you said earlier, and I'm sorry if I missed it, you mentioned San Antonio, right?
Yep.
We talked about San Antonio. San Antonio is specifically noted as a major metro with the most investment activity in Q1. I mean, that's big, right? I'm assuming that's the most in the country. I didn't read the article and went off the highlights, but I would guess that is the most investment in the country. And San Antonio, while it's a decent sized city, it's not the biggest city by a mile. So it seems to be a little bit of a hotbed right now. And friendly reminder, if you're doing a rehab project in San Antonio, if you want, don't forget about the strike team. If you have questions, call the loan officer. We can talk it through. Call our office, but they do have a strike team that looks out for rehab projects to make sure that you get permits and it's done correctly. But No, that's great. I mean, like you said, investing in Texas, it makes sense. It's still very affordable, especially relative to the rest of the country. So yeah, this is good stuff.
Next slide. What's interesting about this is that people always want to say, you don't want to buy at the top of the market. The time that's good to buy if you're a long-term investor is whenever there is, a bit of a buying opportunity. And if you look here, this is what we've been saying: Austin down a little bit, Dallas down a little bit, Houston. Those areas are all in the blue. So it does present a buying opportunity. It's not significantly down, nor do I perceive it ever will be significantly down. There have been a lot of people saying negative things about the real estate market across the country and in Texas for a while. And Texas, even during the great financial crisis, other than Austin, had very moderate price reductions, if any. So very resilient market, but this does present a buying opportunity with what we think lowering interest rates. A lot of good news on the backside here. Anything jumping out from you on this, either nationally or in Texas, that you think about, Stego?
Yeah, I really surprised that Texas was down a little bit. But you're looking at the big three states across the South: California, Texas, and Florida. So it's ebbs and flows with markets being down and being up. So as I said, I think the investors need to come off the bench. I think they need to take advantage of opportunities that are available to them. And, it looks like Texas, I primarily invested in Texas in my career. I've had a few outside of Texas, and they were more flip properties instead of buy and holds. But, we've got a lot of investors outside of Texas that are buying. And, I know we partnered with one Catalyst and investor last month, and he just closed on his first property with the Seago Group. So we're about 5 days into the rehab. He flew down from New Jersey and toured it. Seemed to be pretty happy with everything and the progress so far. So the investors need to take advantage of Texas being down a little bit.
Yeah.
Yeah, I think these.
Go ahead, Jeff. I'm sorry.
I think the second and third bullet points are kind of exactly what we're talking about, right? Buyers gaining leverage as sellers cut prices at record rates. That's exactly what we're talking about. First slide, right? Sellers are in a pinch sometimes, so it creates a lot of opportunities for buyers. And then Texas, Houston specifically, affordability improving where builders kept up with demand, right? Houston and Dallas, I think we built more. I don't remember what the stats were, but it was obscene how much more new construction was going on in Houston and Dallas relative to the rest of the country. I think specifically California. So it does point to these opportunities, like you said, where there's just too many properties for sale, and people need to get out of them sometimes.
Yep. Last thing I'll mention on that, Seago, you have a great point. That one particular investor from New Jersey that bought properties and that flew down for our next Deal Night event. You do not have to live where you invest. You can live in a different place where home prices are more expensive and invest in a place where they're not, like San Antonio, Houston, etc. And if you have the right infrastructure, it can actually be a real fantastic opportunity. What I mean by infrastructure is people who know the local market, like a lender like us, and then people who have access to deals and offer a wide variety of services like Seago with property management and other things like that. I think those things in concert can make investing in an area where you do not live a very attractive opportunity. If you want to learn more about that, be sure to reach out to us in the Seago Group so you can get set up to invest in another area other than where you live in Texas.
I did want to say one thing about that. Sometimes as an investor, you get fixated on the details of the numbers, and you get into a deal. And I think, for example, like there was something that was a little bit more than what was expected on the deal. Like we got into the property and said, hey, there's an issue, we need to fix it. And to his credit, it's like, hey, yeah, this is going to cost me maybe $4,000 more than what I expected. But Wade, you can speak to this because you've been doing the investing for a really long time. I can almost guarantee you that a lot of the investors that are probably not, like Michael said earlier, not cut out for this would have said, nope, I'm out for the $4,000. But I can guarantee 5 to 10 years from now, if this guy still has this property, he will be in such a better place financially by saying, you know what, I'm gonna power through. I'm gonna spend an extra $4,000. I'm gonna get this fixed, and he's gonna have a property that's probably gonna have significant appreciation over the next 5 to 10 years. He'll be wealthier for doing it than not. So it's not always pretty, but if you keep your eye on the prize, what is the long-term goal? Is your long-term goal to have rentals and have long-term wealth? Then a lot of times these little bitty things that come up during the process of a deal, if you can power through it, you're way better off.
Absolutely. I can tell you that many of the opportunities I was most nervous about, like at the time I closed them, if you just hold them over time, works out great. I had one that was an off-market opportunity. I had assigned to somebody I really knew and trusted. They backed out at the last minute. It was a deal in Sunnyside. It's one of my most profitable deals. I think I had it under contract for 15,000. I assigned it for like 20, making a small assignment fee. Ended up taking it down and just putting maybe 15 or 20 into it. Now the place is worth close to 200,000. So, but that deal scared me more than just about any other one because it did not feel like a great opportunity at the time for a wide variety of reasons. But time, appreciation, and cash flow can cure a lot of things, and it certainly did. Certainly did. All right. This next slide. What do you see here, Jeff?
Well, it's funny. It's pretty bad timing because I was going to actually ask Michael about it because he lives in Katy. But I think he's on drop or something. I don't see him. Is he still there? I think it's just the two of us. So hopefully he can get back in.
Yep.
So no, we can talk about it. It's just talking about the top 20 suburbs to live. And Houston, Cinco Ranch made the list. The only thing I'll mention on these types of deals is we talk about everyone talks about diversity, and usually if you're going to buy a property, rental property in a nice suburb like Houston, like a Katy or Spring, Sugarland, a little nicer area, you're probably going to pay up a little bit. Your cash out of pocket's going to be higher. Your cash flow is not going to be as much, but what you are going to get is a very rock solid, steady appreciation. You may not hit a home run if you get like an Edo type property that just flies up, but these really strong suburbs, especially down here in Houston, like they just have a very solid, consistent, safe appreciation. And I think that's what you're getting here. You may not get the huge home runs, but this is a property that you're going to be happy to have.
Yeah, I think it's a data point whenever you're looking at markets that you think are going to rapidly appreciate. But to Jeff's point, I think if you're like, I'm only going to buy properties in Cinco Ranch because the predictions on appreciation, that's definitely a mistake. It's like stocks. It's a dangerous game to just buy one stock. It's like putting all your money into putting all your money into Microsoft. You should have some diversification. You should also have some diversification of neighborhoods. You certainly be all within a certain city, but you can get a lot of diversification just by being, North Houston, South Houston, West Houston, a little farther out, et cetera. There's a lot of diversification that comes from that.
Yep.
All right, the next slide, please. So yeah, this is interesting. The August home sales did, and the thing is, some of the data here is a little bit different. I'm not sure the exact timing than what we showed on the other report, but there are some interesting things to pull out here. 9 out of 10 sellers still achieve their original asking price. That's very interesting. So they don't have to reduce the asking price. That's actually a very powerful number. That was shocking to me.
That surprises me, really.
For flippers, that's actually quite good news there for San Antonio. That's far better than I would have anticipated. And then the home rentals up the 18% year over year in August. I didn't see that exact same data on the other slide, but that is very interesting that it's up 18%. That's a very strong rent rate.
Well, I know. I think what it is I'm looking at it actually, and we're dialed in. It's exactly 18%. I think what they're referring to is the total leases, because I was looking at on our slide.
I didn't understand that, Jeff. I don't know.
Yeah,
if it's breaking up or
sorry?
not. That you kind of broke up a little bit.
Sorry. I think what it's referring to is it's not the price, because you're right. I'm looking at our San Antonio slide for August, and the price is flat, but the total number of listings or leased listings, is up 18%. So it's not the price so much. It's more activity.
It's a little bit of a confusing excerpt there, but yeah, okay.
A little bit, yeah.
Yeah. Okay. All right, so let's go to this next slide. We have a lot of our investors that are in Houston, and while we don't think you should just be uber focused on buying in certain exact neighborhoods, there are a lot of people who ask us, "Hey, Michael, welcome back."
There we
Sorry
go.
about that.
The interwebs are unkind today, I guess. They do that to me sometimes too. Anyway, we're talking about some neighborhoods, and I know, Michael, you do you do deals all over the city. Although you have a couple sweet spots, and you have a sweet spot in the Golden Triangle, Port Arthur area. Do a lot in 77033. We're looking at this slide on Houston suburbs. Do you have any? I know you're just kind of hopping back in. Do you have any opinions on this slide on Houston suburbs and what your feelings?
I actually live in Cinco Ranch. Have lived in Cinco Ranch for the better part of the last 30 years. I do think the master plan communities has some advantages. Cinco Ranch, I think, it's got something like 60,000 homes, and it just keeps growing west. And that's one of the hot spots it's been in the Houston market. I know during 2008, 2009, most of the Katy areas, when we had our financial meltdown, they didn't lose a penny of appreciation, not one penny. Other parts of the city were down. And I know that was a troubling time for our financial markets, but when you look on the flip side, it was a great time for investors to pick up properties for literally pennies on the dollar. I had one client that bought portfolios from banks that were getting ready to go under and picking up whole portfolios for pennies on the dollar, carving out the A+ loans, selling those off, and then taking those B+ loans and the downgrades to make billions of dollars. So even when you have the financial struggles like we had in 2008, 2009, it comes around every few years. It happened during Harvey in the Houston market. It happened during COVID. I think the investors need to jump when they can and take advantage of it.
Yeah. It's interesting. A lot of these statistically premier areas for transactions are in this the northwest rural part of Houston. So definitely seems like an area that is very attractive. And one of the things you can do is get ahead of the growth, right? Home prices are probably going to go up significantly in those areas. And the center of Houston for quite a long time, it was downtown at one point, and it's been moving west. You got Energy Corridor, you've got let's see, the City Center out at the Beltway and I-10, and just a lot of job opportunities, white collar job opportunities, higher income, which leads to higher home prices, have been moving farther west for quite some time. All right. Next slide, please. What do you see here?
Well, it's just I think it was Warren Buffett who said a while ago, he said, if I had all the money that I needed, I would buy every single family, right? So this is just it's a survey, Americans' perceptions of the best long-term investment. And if you look, real estate is number one by a wide margin, right? 37% believe real estate is the best long-term investment. And then you got to go all the way down to 23%, which is gold. So it's, I think the last couple of things there, investor takeaway, strong public preference can reinforce long horizon demand for housing assets. So, this is a situation where the public thinks being in real estate is great, but, affordability is a challenge for a bunch of different reasons. So if you are able to get into an investment that everybody wants when it's difficult for folks to get into it sometimes, I think it just means pull the trigger if you can, right? People want to get into real estate. If you can do it, especially when others are having a hard time doing it, that's a great opportunity.
Anything jumping out here for you, Michael?
Yeah, my investment, I've been in real estate for 30 years. I've been in the stock market, and my wealth has always been in real estate. Positive cash flow, as I said. I don't need to spend the money for the cash flow. It just accumulates, but it's the appreciation of houses. The very first house I ever bought, was new construction at $79,000 in 1996, and today it's worth $380,000.
Hmm.
So it's real estate to me, with the appreciation that you get year after year after year, especially in the Houston market. We just don't see, the last time we saw depreciation on the housing market in the Houston was 1982. It just doesn't go down year after year after year. It just goes up and appreciates. So, one of my top zip codes, which is 77033, those houses have doubled in value in the last 15 years. I mean, we were talking about 120,000 on the top ARV in 2009, 2010, and today we're consistently seeing values at 220, 225, 230 for same size houses as it was 15 years ago. So, my investment is just real estate, whether it's single family residence, fourplexes, duplexes, small apartments. That's where my money is.
Excellent. One other thing I'll point out here, there's only been one time since 2011 where anything was above real estate, and it was gold. And that was at a time when there was extreme panic in the market, right? Because it was just after in the midst of the great financial crisis. And I've looked at charts like this over time, and that in times of extreme fear, that gold will often jump up above, the real estate. But throughout time, it's been real estate above stocks and everything else. And, to go over the reason, and you hit on this, Seago, to a certain extent, but you have appreciation, you have cash flow, you have depreciation, which is a tax advantage, and you can also at a future date pay capital gains tax whenever you sell it instead of paying other types of tax. And then lastly, if you do a cash out refi, that is tax free, which is one of the most beautiful things about real estate. Is that property that Michael Seago has that's worth 380 now? My guess is he's done a few cash out refis. Whenever you get 100,000, you don't pay tax on it whenever you do a cash out refi, which is a beautiful thing, because there are no other places where you're going to get $100,000 check and not have to pay Uncle Sam his fair share. So it's a very unique opportunity. All right. What's that, Jeff? Sorry.
I said, how about the fair part? That's okay. We'll move on.
For sure.
Share.
So, Michael, I know you and your team, your wife in particular, deals with a lot of people who are just as a real estate agent, right? And this is a very interesting slide talking about how so many people who are trying to sell their properties are just moving towards renting them. Are you seeing that dynamic? And what does it tell you about what real estate investors should be doing today?
We get a lot of people that, the kids are off to college, moved out of the house. They, family, husband, wife want to downsize. And my parents are kind of in that position. They've been wanting to downsize for 20 years, and they want all the exact same thing of a 2-story house and a 1-story house. And I just told them, it's like, yeah, you can do it, but you're going to pay twice as much. They don't have the opportunity of downsizing. But yeah, we are seeing some people that are wanting to move out from the suburbs and the city out to the country, living a little bit slower pace. They don't have the great need for the money, and they go ahead and try to rent out their house. And we're seeing some of that. We're seeing some owner finance situations. There's any number of exit strategies for somebody that's looking to downsize or sell their house and go live somewhere else.
Yeah. I think this is not only talking about people that have owned them for a while, but I think people who are either looking just traditional sellers of homes or flippers are also getting into a spot where they're like, had it listed for a while. Maybe in Houston, you see that very large inventory number. So they're converting over to these rentals after they may have had an intention to sell. And I would say one of the things that we're passionate about at Catalyst is getting you pre-approved and letting you know about alternative exit strategies. I hear Seago talk about this all the time. If you're going into a real estate investment with only one exit strategy, that can be a very dangerous situation, especially if that only exit strategy is selling, right? Because you can't necessarily control that. Like, you have to, I guess you eventually list it low enough, you could sell it just about any price, or any environment. But that is not what you want to do. Conversely, if you have this exit strategy like a refinance, you are in control of that, right? You can refinance that properly. And if you either break even or cash flow, you're in a pretty good position. So we always want to get people approved for the exit strategies, let you know the pricing, talk with you intelligently about that. Is a conventional loan best for you? Is a DSCR loan best for you? So that you have multiple exit strategies. You're not locked into only one.
Yeah, I did want to admit, like, I know I'm guilty of assuming that DSCR products are common knowledge everywhere. There's a lot of folks that maybe are on here for the first time learning about real estate investing, and they think, hey, we're talking about buy and hold a lot, but I don't have a W-2 job, or I write things off. I can't qualify for a conventional loan. There are things called DSCR products that are long-term loans for folks that do not qualify for conventional deals. It's based on the property. As long as your credit is okay and the property cash flows, you're solid. Even if it doesn't cash flow, there are alternative products as well for that. So if you're new to this and you want to get into real estate investing and be a buy and hold investor, but you're afraid that you won't be able to get out of it, that's not the case. Reach out to the team. We can talk to you about DSCR products so you can get in the game. I don't want anyone to get frustrated and say, well, all this talk is rentals and I can't buy one. You can certainly buy one.
Yeah, very true. Next slide. This slide is on rental vacancy rate. I'd love to get your opinion on this slide, Michael, as well as your feedback from your property management company on vacancy rates and how that's impacting investors' decisions.
It really, in my career, being my one division with the property management, we haven't had an issue with investors and vacancies. Okay, does occasionally a property go over? Yes. Typical past 30 days, yes, it happens on occasion. But as soon as we get, the way that we work is, as soon as we know that a tenant is going to be moving out, whether they're buying a home or getting transferred out of the city, we start marketing the property about 45 days before they move out. We have the history of the pictures, so we use the previous pictures on the previous listing. We let potential applicants know that it's going to be ready in about 45 days and 1 week. And so that we've got a waiting list. We know people are going to fall off the waiting list. They can't wait. Some will stay in. So, we definitely want to make sure that everybody has that opportunity. We keep our vacancy rates low. We run just under about 5%. And we manage about 240 homes. So we do a little bit better than the averages out there.
That's not surprising. You guys, you seem to be able to rehab for less of a price than much of your competitors, and you also seem to get a higher rent rate faster than most of the competitors. So I know our mutual clients are very happy with that. So we talked about interest rates quite a bit. I don't know that we need to deep dive that any further. I guess you could say one thing off the top is that we're a quarter point down from last year. But I really did want to take a few minutes to go over this affordability index. As I mentioned earlier, San Antonio is such a unique opportunity for the better, like back in 2019, currently in 2024, and certainly here in 2025. If you look at the average income in San Antonio and Houston, they have been in lockstep, always the same. But the average home price there in San Antonio is $279. Houston is $369. Just a massive increase, which shows a lot of upside there for me. And I do think that presents a good opportunity in San Antonio. But still, correspondingly, if you think about Houston compared to everybody else other than San Antonio, it's also just a fantastic opportunity whenever you think about the amenities that Houston has, the job market, all the other things. It's incredibly affordable compared to other cities you would think are comparable to Houston in desirability. Anything else jumping out here, gentlemen?
Not to me.
No.
Go
ahead.
No, I was just saying, not to me really. I know we talk about it in previous ones. And like I said, San Antonio, we always look at the income relative to the price. So you look at San Antonio, average income 65K, Houston average income 65K.
Jeff, I think maybe face the mic.
Sorry. Yeah. I was just talking about the San Antonio and Houston income closeness relative to the home price disparity. Right, you could make just as much money in Houston. I mean, in San Antonio as you can in Houston, but you can buy a house for almost $100,000 less. So, not that I don't think there's any massive swings necessarily. Just more of the same about. There's a lot of good buying opportunities in Texas.
Yep.
Michael,
All right.
No, and as I've said, for, my seminars for the last couple of decades, Houston surrounding areas, our real estate is just so inexpensive here, compared to other major cities across the U.S. And that's why primarily I stay home, in Houston and Texas for my investments.
Absolutely. All right, David. I think we have two things to wrap up. One, were there any questions this week? And then, of course, our drawing.
Yeah, we did have one question. They wanted to get your opinions on the flipping markets. They didn't give a major metro, but just any ideas or thoughts on some good areas that might be good for flipping properties.
I'll give my opinion real quick. I think it's not the easiest market to flip in because candidly, it's a buyer's market and not a seller's market. That being said, if you are able to get homes at a deep enough discount, then it can be a good environment because you can rehab to a very strong level and then have a price that's slightly below the market. But if you're paying at the top of market and expecting to sell it very quickly, I think that is a very bad investment decision. So you need to get a good deal. You need to be able to rehab better than the market and then have a price slightly below the market. And then we see people doing very well with that. We have one couple who they consistently crush it, put out an excellent product. And they are not only they're actually able to list above the market very consistently because they just put out a product, which is, I would not necessarily recommend that because I'm still consistently amazed that they're able to pull it off, but they've done it, I don't know, 6-7 times this year. So we are seeing that, but your product has to be fantastic and you have to get a good price. I don't know that I'm not the type of person that says you just got to go pick one market. I don't know that that's the best move. If you see homes popping off the shelf in a certain market that's a pocket for some unique reason, you can bake that in. But I think the most important thing is the price you buy it and the quality of product you're able to put out.
It's all about the deal. Yeah, no, It's all about the deal. It's about the buy. Like we said in the very beginning. How much are you buying it for relative to the ARV? The rest of it is just anticipating. You have to do a good job, like Wade said, like do a really good job on the rehab. But as far as the financials of it, it's just math. Assume X number of days on market, take a look at what's out there and make sure you buy it right. Just don't get stuck into a deal where you're pushing the upper bands of the price and the rehab relative to the ARV.
I do see one other quick question about interest rates. You say you currently have a 7.5, Anthony Vincent. I would definitely say the rule of thumb typically is if you have a long hold time, you can get a 1% interest rate reduction, that could be a good deal. I think we're probably close to that, either 0.5% if you're holding it for 30 years. But I think it's definitely worth talking with one of our people to see if we can put something together for you if you're at 7.5 for sure. So Jeff, we'll have one of our people reach out to Anthony, whomever, if he's assigned to a loan officer, we'll do that. But yes, I do think it's a good time to entertain refinances. Before we wrap up, I want to give Seago one more opportunity to talk about anything you have coming up or the best way to reach you to find out about off-market deals, anything like that.
Yeah, my phone number and email is on the slideshow right now and being broadcasted. Definitely, and even on our most recent deal night, which was Tuesday night, we had an investor that maybe got sideways on a project. We presented it in the room and get it moved over to another investor. I think Catalyst Wade, I think it was one of y'all's clients.
Yep.
The biggest thing I want to say to investors is we all know that life happens. Nobody is immune to life not happening, whether it's a sickness in the family, a loss of a job, or a project going sideways. By all means, try to reach out to some people that can help you get moved on the project. It's a huge stressor, for you and your family. So definitely reach out to somebody, see if we can help get it moved over to another investor. And because one project may not be good for one investor, but it may turn into something that's really good for another investor. So don't stick your head in the sand. Reach out to us. Let's do what we can to help you out.
Absolutely. That's great advice. All righty. I think that's a wrap. Michael, thanks very much for joining. Jeff, David, thanks for your help. Great job today.
Absolutely.
Wayne,
Just
thank you.
one,
Oh,
one
our
other
winner?
note. We have our winner is going to be Jonas Dahlstrom. So thank you, Jonas, for tuning in. I'll make sure and send a note over to you. So congratulations.
Yep. Thanks, David. Thanks for the reminder. You guys have a great day. Thank you.
Thanks, everybody.